All right, so let's now take a look at transfer pricing and a basic example of 3 different ways that we can do transfer pricing. Again, we're looking at an organization and we're focusing on a decentralized organization where much of the decision-making power resides in the individual subunits. So the company that we're going to be taking a look at in Chapter 22, I'm using the example from the 15th edition text where we have a petroleum company by the name of Horizon. And Horizon has 2 distinct divisions that we're going to be talking about. One division is located in Mexico, and they are going to be referred to as the Transportation Division. In Mexico, the Transportation Division will purchase 1 barrel of crude oil, and they will be able to transfer that barrel across the Mexican-U.S. border and sell it in the United States. Now, they can sell it to another division of Horizon, one of their sister companies in the corporation, the refining division, or they could even sell it to external customers other than their sister company. Okay, so we're going to be looking at those 2, and we're going to try to decide what is the transfer price that the Transportation Division will show as its revenues when it sells those barrels of crude oil to the Refining Division, the sister company, or to external parties. And from the Buying Division, the Refining Division, what are they going to show as their cost of that barrel of crude oil? All right, so that's our transfer price. Managers typically get to have some say in the transfer price that is going to be utilized. Top management uses transfer prices to coordinate the actions of the subunits, but of course also to evaluate the performance of their managers. So consider the fact that for the Transportation Division, the transfer price is going to be their revenue dollars, which they will then subtract their own cost from and get a resulting operating income. And then if you look at the Refining Division's books, their cost is going to be whatever the transfer price is, and they are going to have additional costs that get added to that, and then those items are going to be subtracted from whatever their revenues are, because the Refining Division is going to take these barrels of oil and they are going to process them further and produce gasoline that they can then sell to other companies or possibly even to other sister units within the corporation. All right, so both of them are going to be evaluated, and this transfer price plays a big part in what their individual subunit operating income results are. All right, so the transfer price is the price that one subunit, department, or division charges for a product or a service that's supplied to another subunit of the same organization. And the transfer price creates the revenues for the selling subunit and purchase costs for the buying subunit, of course, affecting each subunit's operating income. The operating incomes can be used to evaluate the subunit's performances and to motivate their managers. Again, we want to keep everybody motivated. We want them working continuously for improvement, to be more efficient, be more cost effective, and do everything they can to improve the corporation as a whole, the bottom line. The intermediate product is the term that we use when we're talking about the product or service that is being transferred in the transaction between the subunits of the organization. All right, so here is our data. Again, the transportation division is located in Mexico. Our refining division is located in the United States. For right now, I'm going to show you guys the basic calculations for transfer pricing, and for the moment, we are going to ignore the tax implications. But I can assure you, there's another video after this one that's going to go into what happens when you bring in the tax effects on these two divisions. What if the rate in the United States is greater than the rate in Mexico? What if the rate that's in Mexico is greater than the rate that's in the United States? Profit and the amount of taxable income times the tax rate is going to make a difference on the corporation as a whole. Okay, so make sure you watch that as well, and that you're able to perform not only these types of examples that I'm about to show you, but also include the tax ramifications into the scenarios as well. All right, so we've got the transportation division. They're in Mexico. They can purchase a barrel of crude oil from their suppliers in Mexico at a rate of $72 per barrel. On top of that cost, the transportation division also has some variable cost and fixed cost that they incur at their division. So per barrel of crude oil, they have variable cost of $1 per barrel, and then their fixed cost based on all the barrels that they handle is broken down to $3 per barrel for fixed, for a total cost of $4. So $4 on top of the 72 means the transportation division basically has $76 per barrel invested. They can bring it across the border from Mexico and they can sell it to the refining division. They can also even sell it to other divisions or other external parties that may be out there that would be interested in purchasing as well. Currently, there is a market price for a barrel of this crude oil, and it's set at $85 per barrel. Now, the refining division, they can buy from the transportation division. They basically have been purchasing, on average, 10,000 barrels per day from the transportation division. But they are also able to buy from those outside parties more at $85 per barrel. The refining division, once they have purchased the crude oil, they are able to then process it further into gasoline. And it takes 2 barrels of crude to produce 1 barrel of gasoline. In order to refine it and produce it from crude oil to gasoline, they have some additional costs. They have $8 per barrel of gasoline and $6 for fixed. So $8 is the variable cost per barrel of gasoline and $6 for fixed costs, for a total of $14 per barrel of gasoline. They can then turn around and sell it for $190 to their external customers. So what we want to know is, when transportation division sells it to refining, what is the dollar amount that we are going to set for the selling price? We're going to look at 3 different ways. We are going to look at the market price, which we can see is $85. It is already set by the other parties involved in the market, the buying and selling of the crude oil. A lot of crude oil is sold out there on the open market. It's $85, and that was easy enough for us to go out there and gather that information. Another one that we're going to look at is some markup on cost. And for our particular example, we're going to say, okay, how about 105% of full cost? Or in other words, what is full cost times 0.05? That's going to be a dollar amount, and it gets added to the cost. The other way you can do it is just to take full cost and multiply it times 105% or times 1.05 in order to come up with the marked up selling price. And then we can also look at a hybrid price, which can be taking into consideration multiple factors. Alright, so if we go and we set those up, you can see here that we have got the first column, B, right here, shows the effects of setting the transfer price equal to the market price at $85 per barrel. What would the results be for the transportation division, and what would the results be for the refining division? All right, when we sell it at $85 per barrel, and we're going to use 100 barrels as our example, we are going to sell it for $85 per barrel times 100 barrels, gives us $8,500 in revenues for the transportation division. At the same time, that $8,500 revenues is now going to show up as a cost line item for the refining division. Okay, so notice it's just brought down here and we've got $8,500. On top of that, we have got to consider all of the transportation division's costs so that we can come up with their respective operating income. We said that the transportation division can buy the barrels for $72 per barrel in Mexico, paying $7,200. They also have their own variable cost and their own fixed cost set at $1 and $3. Multiplying that out times 100 per unit, we've got 100 in variable cost and 300 in fixed. These are costs directly related to the transportation division only. Therefore, if we set the market price, the transfer price, at the market price of 85, the transportation division has an operating income of $900. The refining division, when they refine the crude oil and turn it into gasoline, again, it takes 2 barrels of crude oil to make 1 barrel of gasoline. So if we take this 100 and we divide it by 2, that means we're only going to make 50 of gasoline. And we've already said that they sell them at $190 per barrel. 50 times 190 equals $9,500 in revenues. Now, I want you guys to notice that under all 3 of the scenarios that we are about to look at, the revenues are the same for the refining division. We are selling this to external parties. This is not our transfer price that we are talking about. This is the price that we are selling the final end product for to some other parties. So $9,500 in revenues, this is the same under the market price, column B, under the 105% of full cost, column E, and the hybrid transfer price, column G here. In regards to the refining division's operating costs, not only do they have the $8,500, which reflects the market price as the transfer price, but they also have their own variable and fixed costs that are just in regards to the refining division. Per barrel of gasoline, Notice that this is, again, using the 50 barrels of gasoline. We did not take $8 per unit and multiply it times 100 barrels of crude. We're only applying it to the barrels of gasoline actually made. So 8 times 50 equals 400, and 6 times 50 equals 300. So there's our variable cost, there's our fixed cost. Notice that these are going to be carried across as well, just like the revenues were. What is going to differ in our scenarios here is what the refining division is going to be paying for the transfer price from the transportation division. Alright, so we'll come back in a minute and we'll look at the 7980 number, which is showing up right here, and the 8200 that's showing up right here. But for right now, let's continue on with looking at the operating income for the refining division. They have revenues of $9,500, they have their total division cost of $9,200, and therefore their division operating income results in $300. Alright, so $900 operating income for transportation, $300 in division operating income for the refining division, which results in a $1,200 operating income for the corporation due to both divisions being added together. Looking now at column E, what if for the transfer price we were instead going to use full cost plus 5%? How did we come up with this $79.80 for the transfer price? Basically what we did is we took the transportation division's $72, we added to it their other costs, their variable cost and their fixed cost, a total of 4, to give us a total of 76, and then we mark that up by 5%, or 105%. So if you take 76 and you multiply it times 1.05, you would get 7980. You could also take the 76 and multiply it times 0.05 and get 380 to be able to add that on to the 76 to give you 7980. Whichever way you want to do it does not bother me. So if we sell it at 7980 times 100 barrels equals 7980. Again, notice that the transportation's costs are the same. Their crude oil purchase is still at 72 a barrel. Their variable costs are still at $1 a barrel, and their fixed costs are still at $3 a barrel. So nothing has changed here as well. The only thing that's different is the revenues that they get to reflect based on the transfer price. If we set it at 105, the division operating income for transportation has $380 in division operating income. That $79.80 in revenues for them is $79.80 in cost for refining. If that is the case, the division operating income for refining results in $820. $820. Way better than $300. But $380 here is not near as good as $900. What do you think the transportation division is going to have to say about this one? They would rather be evaluated with a result of $900 than a result of $380. But what about the refining division? They would rather have a $820 as part of their evaluation instead of the $300. Are you getting the drift? We can run into some issues regarding performance. On the transfer price being set hybridly, we'll talk later about different ways that a hybrid price can be determined. But in short, what we have done in this particular example in the text is taken this $1,200 for the corporate-wide operating income and divided it by 2 and made each division's operating income be $600. So could you guys plot that out? Total division cost $8,900. Add back the $600 in division operating income to give you the revenues of $9,500. Could you back into this and tell me a hybrid price? Absolutely. Again, $600 is the other half of that $1,200. Take that and add it to the division cost to give me a revenue dollars of $8,200. And basically what was done is $8,200 was divided by 100 barrels in order to get a transfer price of $82 per barrel. In essence, what we're doing here is we're keeping the total operating income the same. We are focusing attention on the effects that these different transfer pricing methods have on the operating income of each one of these divisions. We're going to talk in just a few moments about what the different transfer pricing methods can cause managers to take different actions leading to different total operating incomes. Again, they're going to be evaluated on their performance, and here you can tell what the differences are. To help a company achieve its goals, transfer prices should meet 4 key criteria, if at all possible. We want to promote goal congruence. We've talked earlier about what goal congruence is, and we would like to have that where managers from the divisions not only are acting in their own interest, but they will take actions that are aligned with the objectives of top management. So again, we're looking at the bottom line for the organization as a whole. Now, we really need to consider this goal congruence when we set the evaluation and performance measures of the management people over these subunits. We want to induce managers to exert a high level of effort. We don't want to make this a situation where it's always some type of cost plus type scenario, because that selling division manager could get a little lazy. They could be inefficient. They could not really care about some of the costs that they incur from a variable standpoint, from a fixed standpoint, etc., because they're just going to pass the buck and send it on to the next division, the one that's the purchasing division in the transaction. All right? So somehow we want to be able to induce them to continue to strive for improvement, to be more cost effective and efficient in their operations. We want to help top managers evaluate the performance of individual subunits. We need to somehow be able to use this information that comes into play when we set a transfer price to help us evaluate the underlying performance of the subunits in the transaction. And then we do, however, still want to try to preserve autonomy of those subunits if top managers favor that higher degree of decentralization. We've seen that we have 3 broad categories of methods that managers can use to determine transfer prices. I'm also going to talk to you here in a few moments about some additional issues above and beyond these 3. So we've seen a market-based, where in a competitive market, a price is set. It is not something that has to be discussed with inside the company to set the number. The market actually sets it. This can be used when there is an external market price for the product or service being provided. And frequently, this may be the price the unit charges outside customers. So recall how I mentioned that the transportation division could also sell to other parties besides just the refining division. With our cost-based transfer prices, this can be used based on the cost of producing the product in question. Just like we've seen in some earlier chapters, recall how we said, all right, when we're going to set the prices for our customers, are we going to consider variable cost only? Are we going to use all cost of production? Are we going to use full life cycle cost? What percentage amount are we going to mark it up? We're going to consider those same types of things when we're coming up with cost-based transfer prices for our fellow subunits. And then lastly, this hybrid transfer price. These take into account both cost and market information. Again, typically we're trying to save that autonomy and give those subunits the ability to have some input. So subunits sometimes are free to negotiate the transfer prices between themselves and then to decide whether or not to buy and sell internally or even deal with external parties. Obviously, the subunits have the greatest amount of autonomy under the hybrid system. We will talk about negotiation here in a few minutes, but I want you to keep in mind that if we've got to negotiate under this hybrid transfer price area, if we've got to negotiate between subunits, that's going to be time consuming. Will one of the subunits have some type of leverage that they're able to use in that negotiation process? Could we have a better negotiator at one division over another? Things like that need to be considered. And again, recall, I've already said this can be a contentious process. So, under what circumstances should each of these options be used? And let's look at each of them in more detail. The market-based transfer prices. Top managers may choose to use the price of a similar product or service that is publicly available. Sources of prices include trade associations, competitors, and so on. And we're looking at these within that market. Recall that we have discussed that a perfectly competitive market exists when there is a homogeneous product with buying prices equal to selling prices, and no individual buyers or sellers can affect these prices by their own actions. Again, it's a competitive market. It's definitely far from a monopoly. Using market-based transfer prices in this environment will allow a company to meet the 4 criteria of evaluating transfer prices. So for those kinds of products or services that are available in a perfectly competitive market, it's great to use that market price as the transfer price just because it does meet those 4 criteria that we've gone over. So it helps us to make optimal decisions because the market for the intermediate product is perfectly competitive. The interdependencies of subunits are minimal because, again, if it is bought and sold on the open market, we can buy it from other parties, our competitors, and we can also sell it to other parties, our competitors. So the interdependencies of the subunits are minimal, if not non-existent. There are no additional cost or benefits to the company as a whole from buying or selling in the external market instead of transacting internally. So in other words, they're null. There is no additional cost or benefits. We're not giving up opportunities, etc. So it kind of eliminates those additional items that could possibly have to be measured. Again, a perfectly competitive market exists when there is a homogeneous product with buying prices equal to selling prices, and no individual buyer or seller can affect those prices by their own actions. And it does allow the firms to achieve goal congruence. It motivates management's effort. The subunit performance evaluations are on an even keel, and it preserves subunit autonomy in the process of buying and selling the product or service. However, perhaps it should not be used if the market is currently in a state of distressed pricing. Now, your text goes into quite a bit of detail regarding distressed pricing. Have we seen some distressed pricing here within the last 2 decades? Absolutely, yes, we have. So basically, distressed pricing is when supply outstrips demand. In other words, we have got way too much product out there available, and the market prices get dropped, sometimes very drastically, many times below their historical averages. And a lot of times this is expected to be only temporary. So consider that a short run price. But sometimes things tank out and they are actually more long run than short run. So we need to take into consideration what's going on economically, system-wide, what's happening in the market. Do we expect the price to stay down long-term, or is this only going to be short-term? And then there are a couple of different ways that management can use pricing for transfer pricing for revenues and costs when you are in a state of distressed pricing. So just know that it's out there. This is another reason why to hang on to your textbook, just in case you have to come back and look some of these things up. But in the short run, the manager of the selling subunit should supply the product or service at the distressed price as long as it exceeds the incremental cost of supplying the product or service. However, if the results are much worse, then maybe the production facilities of the selling subunit may need to be sold off or shut down if it's going to cause major problems for the corporation and losing money. So again, distress pricing, hang on to that book. Maybe at some juncture in your career you might have to come back and think about how the transfer pricing needs to be utilized and reflected when evaluating the organization. Because when the product or service, the price that can be charged for it, is in a state of distress, keep in mind that you're evaluating 2 separate divisions and you're utilizing that in coming to their operating income number. And based on how that number is used, you could get rid of the wrong division. So distress pricing could be an issue. Top managers choose a transfer price based on the cost of producing the intermediate product when we're talking about the cost-based transfer prices. Again, we have seen using our cost as a starting point in setting customer prices in one of our earlier chapters. We're doing the same kind of thing here. We're gathering the information and then coming up with a cost somewhere between variable cost only of production or manufacture, all the way up to possibly full cost, which was the full life cycle cost, including everything after the product has been purchased by the customer, and any warranty or other types of end of life cycle costs that would be incurred. So we could use the full cost basis, some form of the variable cost basis, and of course this is useful whenever there are not any market prices available, or if the market prices are just inappropriate, or if the market prices are too costly to obtain. Again, gathering some of the information that management accountants need in order to do their job sometimes is not always cut and dry and super easy to go out and get. Such as when markets are not perfectly competitive, or when the product is specialized, or when the internal product is different from the products available externally in terms of its quality and the customer service provided for it. You guys should understand that depending on the bells and whistles that come with the product or service, that there are underlying costs that are incurred for those. So quality-wise, customer service-wise, of course, those affect the cost and, of course, the selling price on an open market. Despite its limitations, managers generally prefer to use full cost-based transfer prices because they represent relevant cost for the long-run decisions. We like to plan stuff out in advance. We like to make sure that we're going to cover everything going forward so that we're not caught with our pants down, right? We want to make a profit, not just now, but over the long run. So let's try to recoup our full cost plus a markup. They facilitate external pricing based on variable and fixed cost, of course, and they are the least costly to administer. If we can capture all of our full cost elements, boom, it's in our accounting information system. Our financial reporting numbers are collecting all of this stuff, and so it's least likely to cost us as much time because we've got that. Full cost transfer pricing also, however, raises many issues. How are the subunits' indirect costs allocated to the products? Have the correct activities, cost pools, and cost allocation bases been fully identified? Should the chosen fixed cost rates be actual or budgeted? You guys can actually use either one when we're trying to go about calculating our cost. And then lastly, with our hybrid transfer prices, again, we're going to take into account both cost information internally, but also things about what is going on out in the market related to prices, quality, and other aspects that maybe are different with our competitors. Top management may set the prices by specifying a transfer price that is an average of the cost of producing and transporting the product internally and the market price for comparable products. So in other words, we're going to take our price plus the cost of producing and transporting it internally and add it to the market price that's out there available for comparable products. Add those two dollar amounts together and divide by 2 to come up with one that's the average or in the middle. The one that we did here just a few moments ago, we did have a result where if you were to go back and look at that PowerPoint slide, our market-based price was $85 and our hybrid price ended up being $82, and then our cost plus 5% ended up being $79.80. So our hybrid price in that example was actually not in between the other two. It was actually higher But again, what did we do there is we split the operating income as a total and divided it 50% to each one of the subunits. Excuse me. There are some types of hybrid transfer prices that are notated in the text. We can prorate the differences between maximum and minimum transfer prices. I will also discuss the fact that the corporation can actually do some journal entries. We can have two different transfer prices used in our records or in our reporting for the divisions. So let's say we use one price for the selling division and another price for the buying division. Okay, so there's a difference between the two. That can actually occur, and the corporate accounting department can literally make a journal entry into a distinct corporate account to do what needs to be done corporate financial statement wise for those variations in the two numbers that were used between the two divisions. Negotiated pricing, as I mentioned earlier, is the most common form of hybrid transfer pricing. But again, think about what could be going on there. Occasionally, subunits of a firm are free to negotiate the transfer price between themselves. So the buying unit and the selling unit get together and hash it out. And they can also sometimes decide whether to even buy and sell internally or deal with external parties. So we've talked about that autonomy that we're trying to continue on with in a decentralized organization. Many times they may or may not bear any resemblance to the cost or market data. And again, the negotiated pricing many times is used whenever the market prices are just volatile. They take into consideration what's going on in the market, but they don't want to follow it because of that volatile nature. So they try to come up with a fair and square price, considering what's going on in the market, so that it's not so difficult to constantly be changing that number. We'd rather just kind of set one and negotiate one out for a time period. A negotiated price does represent the outcome of a bargaining process, again, between the selling and buying units. But keep in mind what I said. Do you have one division that is better at negotiating? Does one division have some type of leverage that they can hold against the other one in the negotiation process? Are we going to have some personality conflicts that come into play? What about experience or education of one of the negotiators over another one? Think of what's going on there. So the dual pricing is what I was mentioning, where it's one of our hybrid versions. Again, one division would show one price and the other division would show another price, but corporate accounting can go in and do a journal entry. Prorating the difference between the maximum and the minimum cost-based transfer prices is possible. Dual pricing is like I just mentioned, where we can use two separate transfer pricing methods to price each transfer from one subunit to another. For example, what about the selling division receives full cost pricing? So whatever their full cost is, that is what they're going to show as the selling price. But then the buying division gets to show that they are actually paying market pricing. Again, we could actually sit down and compare these three major points of transfer pricing methods that we have seen based on the 4 criteria for evaluating the transfer pricing methods shown. All right, so again, we've got the 4 criteria. Does it or does it not aid us in achieving goal congruence? Does it or does it not motivate management? Does it or does it not aid us in evaluating subunit performance? Does it or does it not aid the subunits in continuing on in their use of autonomy? And then there's some other factors. So make sure you guys read through this chart and consider the example that we have looked at and what the effects are of using the transfer pricing method, not only from the eyes of the C-suite corporate management, but look at the different methods from the eyes of the subunit managers. They are going to be evaluated on their operating income. Which one are they going to be the happiest in using as the transfer price from their standpoint? Which one is going to be mediocre? And which one is going to be the last one that they would want to have used when they are going to be evaluated on their performance? Go back and take a look at those. Again, I did mention dual pricing and how it's able to be used, and that there can be a journal entry at the corporate account level in order to make that difference between the 2 prices show accordingly in the financial reports. Dual pricing, according to the publisher, is not widely used because it can make dealing with our taxes difficult, because as we've seen in the example, we've got one division that's in a different country. Of course, we've got Mexican taxes, and then we've got United States taxes. You'll see in the next video that there's not just federal taxes that we're concerned with. We can have divisions in different states. There are state taxes, there are payroll taxes, there are all kinds of taxes out there that come into play and can affect our transfer pricing decisions. Dual pricing can also have some other intercompany issues. Regarding the minimum transfer price, the minimum transfer price in many situations should be equal to the incremental cost per unit that is incurred up to the point of transfer, plus the opportunity cost per unit to the selling subunit. And we have seen that an opportunity cost is what we are giving up. So the incremental cost is the additional cost of producing and transferring the product or service. We can go back, we can look at our example in the textbook and find out what all our costs were for producing our item and transferring it over to the next division. And then we would want to add to that whatever we would be giving up by not selling it to the next available party if we gave up that opportunity.